Here is the overview of today's gold market news. Gold price performance, price trends, and technical outlook. Gold faces crosswinds from Federal Reserve policies, investor sentiments, and Moody's downgrade. Safe haven no more. Gold declines as investors embrace risk on easing geopolitical fears. Let's look at the latest gold price performance, price trends, and technical outlook. June gold futures ended the week at $3,188.80 an ounce, marking a 4.6% decline from the previous week. This drop pushes gold below the $3,200 level, a psychologically important support zone that had held firm for 5 weeks. Gold has declined approximately 9% from last month's all-time high of $3,500, indicating a strong short-term downtrend. Gold experienced a sharp late-week rally, reversing its previous decline and closing above $3,200 an ounce. This price surge occurred in the final minutes of the trading week, following a surprise downgrade of the U.S. credit rating by Moody's Investors Service. The move underscores gold's traditional role as a safe haven asset, especially in times of rising economic and political uncertainty. Investors, seeking protection against financial instability, shifted capital into gold, resulting in a solid price recovery. This rebound highlights how fast market sentiment can turn, particularly when trust in the financial strength of the world's largest economy is questioned. Gold prices are under significant pressure and could fall further next week, according to several market analysts. The market is currently in a wait-and-see mode, as investors reassess risks and recalibrate expectations based on recent economic and geopolitical developments. Analysts believe gold could test support below $3,000 per ounce in the near term. However, they emphasize that this is a natural market correction and not a cause for panic. Despite the short-term pressure, the gold market is anticipated to maintain a bullish long-term stance due to unsustainable global debt levels, persistent inflation risks, ongoing but diminished safe haven investor demand. The short-term moving averages are trending toward a bearish crossover, a signal of continued downward momentum. A breakdown below the double top pattern is seen as confirmation of bearish sentiment. The firm recommends against fresh investment in gold until technical confirmation supports a change in trend. While gold is struggling, silver is showing relative strength, offering a potential opportunity for investors. June silver last traded at $32.26 an ounce, only 1.5% lower on the week. Silver has held key support above $32, suggesting greater resilience. The ratio has fallen below 100, meaning it now takes fewer ounces of silver to buy 1 ounce of gold. This decline highlights silver's outperformance relative to gold. Analysts believe silver is positioned to benefit as investors rotate away from gold and toward industrial metals amid easing recession fears, which renewed focus on manufacturing and industrial activities and increases silver demand. Analysts suggest this could be a strategic time for gold investors to diversify into silver, given its dual role as both a precious and industrial metal. Next, let's look at how gold faces crosswinds from Federal Reserve policies, investor sentiments, and Moody's downgrade. This week's downturn is the steepest since mid-June 2021, and even sharper than the drop seen in November 2016 following President Donald Trump's election victory, when investors moved out of safe haven assets amid expectations of fiscal stimulus and growth. Gold is currently caught between two diverging and opposing forces that are shaping investor behavior and fermenting market uncertainty. On the macroeconomic front, the U.S. reported softer than expected inflation, increasing expectations that the Federal Reserve may cut interest rates in the second half of 2025. Federal Reserve Chair Jerome Powell signaled possible challenges ahead, cautioning that inflation could become more volatile due to supply-side shocks. Improved investor sentiment around economic growth is reducing demand for gold as a protective asset. Stronger risk appetite is leading to asset rotation into equities and industrial commodities. A weaker than expected U.S. economic data has increased market expectations for Federal Reserve interest rate cuts. A lower interest rates and a weaker dollar typically support gold as a non-yielding asset, as when bond yields fall, the opportunity cost of holding gold decreases. A weaker US dollar, which often accompanies rate cuts, also tends to boost gold prices in non-dollar currencies. Despite this, the bearish technical structure and improving sentiments are keeping prices under pressure for now. Analysts note that although sentiment has improved, uncertainty still dominates many market narratives. They suggest this will likely limit gold's downside, even if it doesn't catalyze a sharp rebound immediately. Investors are taking a wait-and-see approach, arguing that gold is in a tug-of-war between short-term pessimism and long-term structural supports, such as central bank gold purchases, geopolitical instability, inflation hedging, fiscal debt concerns. Gold may require a consolidation period before the next leg higher, but the underlying bullish drivers remain intact. The market will closely monitor key U.S. economic indicators that could influence gold and broader sentiment, such as the weekly jobless claims, which may signal shifts in the labor market and influence Federal Reserve policy expectations. The existing home sales report due on Thursday and the new home sales report release on Friday could affect inflation and growth expectations and consumer confidence and housing market conditions. These data points may determine whether expectations for Federal Reserve rate cuts strengthen, which in turn would impact gold and silver pricing. Moody's had downgraded the U.S. sovereign credit rating by one notch, from AAA to AA1. While still a strong investment grade, this move is highly symbolic and influential. The downgrade was based on growing concerns over the long-term trajectory of U.S. debt and the cost of servicing it. Over more than a decade, government debt and interest payment ratios have risen to levels significantly higher than those of similarly rated sovereigns. The outlook was revised to stable, meaning further downgrades are not anticipated in the immediate future, but the fundamental fiscal picture remains negative. Moody's was the last of the big three rating agencies to maintain a top-tier AAA rating for the U.S. After this move, no major agency considers U.S. sovereign debt risk-free, reflecting a shift in how global institutions perceive American fiscal management. Moody's downgrade also reflects skepticism about the effectiveness of recent U.S. government efforts to tackle debt and reduce deficits. The austerity measures enacted through the Department of Government Efficiency, a new government body overseen by Tesla CEO Elon Musk, had promised $2 trillion in spending cuts. But reports suggest that the actual verified savings are under $100 billion, just 5% of the original target. Thus, the downgrade indicates that current reforms are perceived as superficial or insufficient in scale. Moody's criticized the political system's chronic inability to agree on long-term fiscal reforms, such as structural changes to mandatory spending programs like the Social Security or Medicare, and solutions to growing annual deficits. Moody's do not believe that material multi-year reductions in mandatory spending and deficits will result from current fiscal proposals under consideration. The market had limited time to digest the news of the downgrade, as it occurred after market hours on Friday. Nonetheless, some clear reactions emerged, such as the surging of gold, showing renewed safe haven demand. The U.S. Treasury yields had moved higher, likely due to fears that the downgrade could affect demand for U.S. debt and increase borrowing costs for the government. Thus, the downgrade indicates that current reforms are perceived as superficial or insufficient in scale. Moody's criticized the political system's chronic inability to agree on long-term fiscal reforms, such as structural changes to mandatory spending programs like the Social Security or Medicare, and solutions to growing annual deficits. Moody's do not believe that material multi-year reductions in mandatory spending and deficits will result from current fiscal proposals under consideration. The market had limited time to digest the news of the downgrade, as it occurred after market hours on Friday. Nonetheless, some clear reactions emerged, such as the surging of gold, showing renewed safe haven demand. The U.S. Treasury yields had moved higher, likely due to fears that the downgrade could affect demand for U.S. debt and increase borrowing costs for the government. Moving on, is gold still considered a safe haven asset? Here is why gold is in decline as investors embrace risk on easing geopolitical fears. Several analysts point to a shift in investor sentiment as the key driver behind the recent gold weakness. Optimism around the global economic outlook is reducing the need for traditional safe haven assets like gold. Analysts note that recent positive trade talks between the U.S. and China are easing concerns about a global slowdown, which is a major factor in the decline, and President Trump's Middle East diplomatic efforts and trade deals have further calmed geopolitical tensions. The tariff reduction deal had increased confidence that the trade war may ease, reversing the uncertainty caused by President Trump's earlier reciprocal tariffs. The agreement led to renewed investor interest in equity markets and improved sentiment about the U.S. economic growth, draining demand from gold. This shift is part of a broader trend. When geopolitical risks ease, gold, typically used to hedge against turmoil, loses its appeal. Gold prices fall as investors withdraw their money to invest in high-risk assets like stocks. Other geopolitical developments have also reduced safe haven appeal, such as the temporary truce between India and Pakistan and the 90-day pause on tariffs between the US and China. However, uncertainty remains regarding the Russia-Ukraine conflict, which could potentially reintroduce volatility into the market.